Robert Aspin, Head of Equity Investment Strategy at Standard Chartered, as well joins in on the show. Robert, hi, morning. Firstly, a word in India. We touched a lifetime high yesterday after the outcome of the state election results. What's your view on the Indian markets right now? Do you see this rally sustaining amidst all the global data points that we're still awaiting? Still a big question mark on when is, or rather what's going to happen with tapering?
Well, I think in the short term there is the possibility that the market could continue higher based on positive technicals. Given the fact that it has broken higher, we take the view that it may continue up for a few more weeks. But from our standpoint, we are neutral, the Indian market, within our global positive bias towards equities. So we do like equities at the global level, but we do prefer the US and Europe at this point in time, and I have more of a neutral allocation to India within our Asia ex-Japan underweight. Now, just to give you some specifics in terms of the India market, we do think there are great opportunities within the market, in particular sectors like technology, for example, industrials and healthcare, but we're a little bit more concerned in terms of the impact of tapering. We're expecting tapering to take place sometime in Q1, and on the back of that, we're expecting yields to pick up in the US, and also for the US dollar to strengthen against, aside from others, the Indian rupee. So we're expecting the rupee to weaken by around 5% or so over the course of the next 12 months, which is obviously going to impact the returns from the Indian markets. But overall, we would take the view that the market could, over a 12-month period, generate returns in excess of 10%.
Are you increasing your exposure to IT and pharma like you just mentioned, or are you just holding on to what you already bought?
Well, we're actually recommending to clients to do a modest switch between IT and healthcare. So we like both spaces, but we've actually been very overweight IT now for around 6 months plus, which has actually worked obviously very, very well, given the fact that the sector is up close to around 50% on a year-to-date basis. So we see some opportunities on a stock-specific basis within the healthcare segment. There have been a couple of laggards, and we expect them to perform a little bit better. Likewise, industrials, we have seen the order books come in quite nicely, and we're expecting the industrials to play catch-up as well. Technology, though, it has performed very well, but when you look at the underlying fundamentals for technology, it should remain quite a strong sector going into the 2014 period.
Robert, historically all emerging markets moved in a synchronized manner. Courtesy global liquidity, be it China, India, Brazil, Russia, it's a rising tide which has taken every emerging market up in a similar manner. Do you think now there is a serious case for India to outperform other emerging markets? I was just looking at emerging market data for last 1 month, and India is a standout mover.
Yeah, it's been a very strong move, but if you look at the performance overall of the emerging markets, particularly the ones that you just mentioned, they've actually lagged the developed markets like Japan, the US, and Europe on a 12-month view when you look historically. Going forward, there is room for catch-up, but we do, as I said, think that tapering will impact returns negatively. And the second point of view is when you look at the growth coming out of the US and Europe, growth is improving. Expectations for growth is improving. Hence our modest bias towards the developed markets relative to EM. In terms of India versus other markets, if you look at Russia, for example, it's very, very cheaply valued at this point in time. Likewise, China, in our opinion, is quite cheap, particularly the financials. Now, obviously, there's a lot of risk within the financial segment, but there is some value there as well. So we don't see India necessarily outperforming EM significantly at this point in time, hence our neutral allocation to the market.
Robert, last Friday when the US non-farm payroll data came out, my first reaction was, oh, it's bad news for equities. This means Fed could prepone tapering, and that's bad news for equities as an asset class. But the reaction to that rather strong data is strange. US markets and emerging markets have rallied after a strong non-farm payroll data. What explains the bullish undertone?
Well, I guess to some extent you can argue that the emerging markets did underperform over the last 12 months, and therefore, to some extent, tapering news has already been priced in, number one. Number two, it's very likely, given the fact that inflation is trending down in Europe and also in the US, that when the Fed does eventually taper, the size of the tapering is going to be fairly limited. So we're forecasting something in the region of around $10 billion to start off with, but it may indeed be even lower than that. Our forecast currently is that it's going to be Q1, most likely in March, but I agree, more commentators are considering December as a higher possibility now, given the fact that the labor data was strong. But the Fed will also be focused here on the housing data, and whilst prices in the U.S. housing market have continued higher, the underlying data has been a little bit more mixed. So I think the Fed will be fairly conservative, both in terms of the timing and also in the extent of tapering going forward. A third point that I'd like to make here is that the ECB also chopped rates down 25 bips, so down to 25 basis points in terms of rates. And they've obviously indicated that they will maintain very easy monetary conditions should be required. Likewise, in the U.S., liquidity is fairly abundant, and even with tapering, the Fed will still be pumping in something in the region of $70 billion into the market on a monthly basis. Yes, that will obviously reduce going forward, but rates are still very, very low.
Robert, good chatting with you. Appreciate you taking the time out and speaking with us.